All right, let's jump right into the wild, fast-paced world of crypto day trading. It's a space that's absolutely buzzing with energy, pulling in a whole new generation of investors who are chasing that incredible volatility and the promise of some really quick returns. But what's actually going on behind all those flashing charts?
31. So, what's with the number? Well, according to the trading platform Robinhood, that's the average age of their users. And, this isn't just some random statistic. It really paints a picture of who's diving in. We're talking about a new breed of investor, young, totally comfortable in the digital world, and ready for a market that moves at the speed of light. They're basically reshaping the entire landscape.
And this quote from a thesis out of ETH Zurich really nails why it's so popular. It's basically two things, right? On one hand, you've got this belief in a new kind of technology. But on the other, you have the raw, undeniable pull of that insane rise in price. And honestly, that combination has proven to be pretty much irresistible for a lot of people.
So let's dig into that Allura a little bit. Because for a lot of people, this isn't just about throwing money at something and hoping it goes up. No, it's a really sophisticated hunt for a genuine, provable edge over the market. So at its core, crypto day trading is all about speed. You're not holding on to an asset for years, hoping it'll grow. Instead, you're trying to make money off of the little price swings that happen in just minutes or hours. The whole idea is to stack up a bunch of small, quick wins from many trades. And, crucially, you close out all your positions by the end of the day, so you're not exposed to any crazy overnight news. Now, to make this happen, traders have a whole playbook of strategies. First up, you've got scalping. This is where traders make tons of trades a day, just trying to skim tiny profits off the top. We're talking in and out in seconds. Then there's range trading, where you spot a price channel that a crypto is bouncing between, and you buy at the bottom and sell at the top. You've also got momentum traders, who are trying to catch a wave, riding a strong trend that's maybe driven by good news. And finally, there are breakout traders, who wait for a price to punch through a key level, betting that a whole new, stronger trend is about to start. Each one takes a ton of discipline. And here's where it gets really fascinating. It's not just individual traders trying to find that secret sauce. Academics are in on it too. Researchers are building and testing algorithms to see if a machine can systematically find a way to profit from all this chaos. So how do they measure if it's working? Well, they use this metric called the Sharpe ratio. And it's a brilliant little tool because it doesn't just ask how much money did you make. It asks how much money did you make for the amount of risk you took on. The higher the ratio, the better you've done for the risk you were exposed to. And when you look at the results of that study, wow, the numbers are just staggering. The algorithm's Sharpe ratio was almost 3 times better than just buying and holding Bitcoin. But here's the real kicker. Look at the risk. The biggest potential loss, what they call the max drawdown, was slashed from a heart-stopping 85% all the way down to just 25%. It's proof but a systematic approach is possible, which is pretty much the holy grail for serious traders. Okay, so that's the dream, right? A data-driven edge. But these strategies don't exist in a vacuum. They happen inside a trading environment that's full of hidden traps. It's an ecosystem designed to do one thing: keep you trading. And this is where things get a bit dark. A recent report from the big global group of securities regulators, IOSCO, found that the very platforms people are using can actually push them into riskier behavior. Think about it. Something as simple as a push notification on your phone can make you take on more risk. And this hits younger, less experienced investors the hardest. Regulators have a name for this: gamification. It's all these little features designed to make trading feel like a game. You get trading bonuses, you see digital confetti when you make a trade. You can even copy what other traders are doing. All these little digital nudges can turn careful investing into something that feels more like an impulsive video game. And then there's the big one: leverage. Basically, it's trading with borrowed money. Now, sure, it can juice up your gains, but it's a serious double-edged sword. It can magnify your losses just as fast, often even more dramatically. And that's a risk a lot of people don't fully get until it's way too late. And of course, you can't talk about this without mentioning social media. It just adds a whole other layer of chaos. You see the promise of life-changing money from so-called finfluencers, but the reality is often a ton of pressure from FOMO, people pushing products that aren't right for you and sometimes just straight-up scams. So, with this crazy mix of high-risk products and all these new digital dangers, what are the financial watchdogs around the world actually doing to protect people? Well, a really key player here is IOSCO. Think of them as the global club for all the world's securities regulators. Their whole job is to get everyone on the same page to make sure markets are fair and investors are protected no matter where they are in the world.
And they're not just sitting around. These regulators are taking some pretty concrete steps. They're actively keeping an eye on social media for any funny business. They're using their power to ban or restrict the sale of the absolute riskiest products. They're working together across borders to chase down scammers. And they're putting out alerts to warn all of us about the latest threats. And this isn't just theoretical stuff. Just look at Australia. Regulators there found that about 80%, that's right, 80% of regular people lost money trading something called binary options. So what did they do? They just banned them for retail investors. Plain and simple. That's real decisive action based on hard data. So where does that leave us? On one hand, you have this amazing access to tools and potential strategies. But on the other, you have this whole ecosystem of risk and seduction. What does it all mean for the future of your money? At the end of the day, this isn't a simple good versus evil story. The crypto market really does offer incredible opportunities. The thing is, all that opportunity exists inside a system that's often built to just keep you clicking, keep you trading, all of it amplified by the social media hype machine. That makes for a really complex and, frankly, challenging environment for any investor. And that really leaves us with one final big question to chew on. In this new world of gamified trading, social media hype, and markets that never sleep, who is ultimately responsible for protecting your money? Is it the job of regulators to put up guardrails? Should the platforms be more ethical? Or, in the end, does it all come down to you, the investor? Definitely something to think about.